Welcome to Staffworks Explained. If you are here for the first time, please consider subscribing to this channel. You can also hit the notification bell so that when we upload a new video, you are among the first people to be notified. In today's video, we'll be asking our question: where is Project Oil Kenya today? We know that Kenya Oil's journey has been long. It has been uneven and even at times politically louder than technical. More than a decade after the first commercial discovery was made in Turkana County, the country is still not yet an oil producer. Yet, for the first time since exploration began, Kenya is closer to a final investment decision than it has ever been. Whether that proximity translates into barrels on the market is now a question of execution, governance, discipline, and realism. Here we tell a story of how Kenya got here, where it truly stands today, and what must change if oil is to move from promise to production. Let's start by having a brief history from discovery to delay. Kenya's upstream oil story effectively began in 2012, that is about 14 years ago, when Talo Oil announced a significant oil discovery at Ngamia 1 well in South Lokichar Basin of Turkana County. Subsequent discoveries at Twiga, Amosing, and Kales confirmed a working petroleum system. For a frontier basin, this was a material success. By 2016, the government and partners declared that the discovery were commercially viable and expectation rose quickly. However, discovery is not development. The years that followed exposed gaps in alignment between subsurface reality, infrastructure planning, financing appetite, and state capacity. In 2020, Kenya pursued early oil pilot scheme (EOPS), tracking limited volumes of crude from Turkana to Mombasa for export through the road. While symbolically important, EOPS was never a development project. It did not de-risk the field, attract financing, or even establish permanent infrastructure. Its value was political and informational, not commercial. By 2023, Talo Oil was financially constrained and openly seeking to exit Kenyan market. This is after the withdrawal of its joint venture partners. This marked a critical turning point. Kenya's progress stalled not because oil was absent, but because capital and execution were certainly absent. What's the current status? What is claimed and what is certain? According to the official government briefings and operator communications, the upstream assets in South Lokichar of Turkana Basin, where we have blocks T6 and T7, which were formerly 10BB and 13T, are now associated with the revised development plan FDP, targeting first oil in the second half of the decade. It has been publicly stated that Talo Oil agreed to sell its interest to Gulf Energy EP and BV, and that a revised field development plan was submitted to the government with approval reportedly granted at executive level and now is awaiting parliamentary ratification. Parliament is currently doing a public participation. However, from a project governance standpoint, it is important to be precise. Parliamentary ratification is not procedural. It's a legal requirement under Kenya Petroleum Act. Until ratification is complete, the final investment decision is taken. Kenya is not in the development phase. Production starts date, including those cited for 2026, remains target, not committed schedules. This distinction matters because upstream oil projects fail most often in the gap between approval in principle and financial close. What the proposed development looks like. Now let's look at that. The revised development concept as presented reflects lessons learned from earlier stalled plans. The project proposes a phased development approach. Phase 1 will target approximately 20,000 barrels per day, scaling later to around 50,000 barrels per day if reservoir performance and economics allow. This is a risk management managed strategy, reducing upfront capital exposure while preserving upside. The plan consolidates multiple fields, Ngamia, Twiga, Amosing, and Ekales, this into a shared central processing facility, CPF. This reduces duplication of service infrastructure and operating cost, a necessary adjustment given today's capital discipline in the oil industry. Recoverable resources are estimated in the range of several hundred million barrels. These figures are plausible for South Lokichar, but it must be stressed that recoverable volumes are not reserves until sanctioned and financed. Let's look at the infrastructure, which is the weakest link. Infrastructure remains the single biggest uncertainty. Kenya's regional plan hinged on a dedicated Lokichar-Lamu crude oil pipeline, which is integrated with Lapsset corridor. That pipeline has not progressed beyond planning. In its absence, interim solutions such as road or rail transport to Eldoret are being discussed. From a project management perspective, these alternatives are costlier per barrel, operationally risky, and environmentally more exposed. They are workable only at modest production rates and for limited periods. Without a pipeline, Kenya oil will struggle to compete regionally. Let's compare with Uganda, which we say these are two paths and one basin. The contrast with Uganda is instructive. Uganda discovered oil earlier than Kenya and faced similar challenges. Uganda is landlocked in geography, in terms of geography. It is an environmental sensitive, and also there was also financial complexity. Yet Uganda made three decisive moves which Kenya has not done. One, it locked in development partners with strong balance sheet. We have Total Energies and SNOC and others. Kenya, we had tallow oil, which can be described as weak, having a weak balance sheet. It took a clear, centralized decision on export infrastructure. It also executed host government agreements early. The result, now we have the East African crude oil pipeline, EACOP, which is now under construction. It has made tremendous progress. And this pipeline links Ugandan fields to the Tanzania coast for export purposes. Kenya and Uganda did explore shared pipeline options in the past. These discussions collapsed under misaligned timelines, differing crude specifications, and also political competition. In hindsight, that breakdown has cost Kenya leverage and optionality. Today, Uganda is in the execution. Kenya is still in approval. Should there be competition or collaboration between the two countries? In theory, oil markets reward collaboration. In practice, upstream development is nationalistic. Kenya now faces a strategic choice: continue pursuing a standalone pipeline with uncertain economics, or reopen regional infrastructure discussion from a position of realism rather than rivalry. Collaboration is no longer about prestige. It's about lowering break-even cost in a world where investors are selective and capital is success. Let's now look at the benefits that Kenya might realize if this succeeds. If and only if Kenya reaches sustained production, the benefits are tangible but should not be overstated. They include government revenue through profit, oil, and taxes, regional infrastructure development, skills transfer in petroleum engineering and project execution. Then we have reduced import dependence for refined products over the long term. Oil will not transform Kenya's economy, but can meaningfully supplement it if governed prudently. There are challenges that still remain. There are several obstacles that remain unsolved. One, we have the financing in a high cost onshore frontier environment. We have community consent and land access in Turkana, regulatory capacity to audit cost and enforce fiscal discipline. And then we have alignment between national ambitions and commercial reality. Raising cost recovery ceiling may attract investors, but it also defers government revenue. That trade-off must be transparently justified. What Kenya must do now? To become an oil producing country, Kenya must move beyond announcement and focus on 5 execution imperatives. 1. Complete parliamentary ratification without politicization. Secure credible project financing. Make a final bankable decision on export infrastructure. Strengthen regulatory oversight of cost and schedules. Manage expectation domestically as well as internationally. Oil projects fail quietly, not loudly. Success is measured by in terms of barrels which are delivered, not plans that have been unveiled. In conclusion, we can say that Kenya stands at a narrow threshold. The country has oil. It has learned hard lessons. It has proposed development path that is more grounded than earlier attempts, but it does not yet have production, financing closure, or infrastructure certainty. Uganda's product is not a rebuke, it is a reference case. Kenya can still succeed, but only by replacing optimism with discipline and competition with pragmatism. Project Oil Kenya is no longer about discovery, it's now about delivery. So thank you for reaching this far. If you are here for the first time, please consider subscribing to this channel. You can also watch other videos that you have done on this project and other projects across Kenya, East Africa, and Africa at large. Thank you.